A human sits at a desk, staring at a red stock market chart on their phone. His name is Daniel. 10 minutes ago, the news alert popped up. US-Iran tensions escalate, markets falling. Daniel's first instinct? Sell everything. Get out. Wait for the dust to settle, and honestly, I've seen this moment thousands of times because I'm money. I travel through markets, wars, crashes, and booms. Every time conflict hits the headlines, humans repeat the same pattern. Panic, selling, fear. But here's the strange part. While millions of investors rush for the exit, some quietly get richer, not because they predicted the war, but because they understand how money actually moves during crises. Nearly every time there's a conflict, people panic and sell. But smart investors do something different. They look for opportunities. Today, I'm going to show you the pattern that appears every time a conflict begins. Once you see it, you'll never watch war headlines the same way. If you've turned on the news this week, you know what's happening. US-Iran tensions have escalated. Strikes, military movement, fear spreading. Right on cue, your financial feed is full of predictions. Oil spiking, defense stocks up, gold catching a bid. And millions are asking Daniel's question, should I sell everything? Here's what nobody tells you. The last several major conflicts, Gulf War, Iraq, Afghanistan, Russia-Ukraine, all followed the exact same pattern. Most investors got it completely wrong. They panic sold at the bottom or chased defense and oil at the peak. Both options hurt. By the end of this video, you'll understand the 3 phases markets go through during any conflict, and you'll know how to position yourself without panic. I'm not going to tell you how this conflict will play out. I have no idea. Neither does anyone else. Pundits who sound certain? Guessing. Headlines designed to make you click? Feeding on fear. What I can show you is what actually happens to money during war. History and patterns. Let's start with the obvious. War scares people. Markets hate uncertainty. When tensions rise, panic follows. Investors hear about missile strikes, military movements, oil risks. They do what humans are wired to do. They run. Stocks get sold. Cash positions increase. Markets drop. From my side, it looks like a stampede. But here's what most miss. When you sell a stock, I don't disappear. I simply move to someone else's account. Every sale has a buyer, and that buyer usually isn't panicking. The stock market in the short term is a voting machine. Whatever's popular goes up, whatever's unpopular goes down. And in the short term, it's terrible at this. It overreacts to bad news, overreacts to good news, driven purely by emotion. When scary headlines hit, and a potential war with Iran is as scary as it gets, the market's first reaction is almost always to sell. That instinct, get out, wait for dust to settle, get back in when clear, has cost investors more money than almost any other behavior. Because although the market is a voting machine in the short term, it's a weighing machine in the long term. Fundamentals drive value over time. Look at the S&P 500 since the 1950s. Wars, crises, scandals, recessions, pandemics. On the long-term chart, they barely show up. Korean War, active conflict. S&P returned about 142%. Cuban Missile Crisis came within days of nuclear war. The market kept going up. Vietnam. Through Nixon's resignation through Watergate, the market kept climbing. Reagan, stagflation, 18% mortgage rates. Black Monday fell 22% in one day. His presidency finished up 109%. Gulf War, Iraq invades Kuwait. Oil spikes, market sells off. That presidency still returned 57%. Clinton, 208% growth. Through savings and loan crisis. Through dot-com bubble start. Bush, September 11th, market drops 14% in a week. Iraq War, housing crisis. His presidency finishes down 37%. Obama inherits the rubble. From near collapse, S&P returned 167%. Trump, up 68%. Through Brexit, through COVID, a global pandemic, market finished positive. Every crisis, every war, every crash, every pandemic, all just blips on a chart, relentlessly moving upward over time. These events feel enormous when you're living through them. On the chart, they're footnotes. Morgan Housel. Every past bear market looks like an opportunity. Every future one looks like a risk. Why does this pattern exist? So you believe it when headlines are terrifying. The market is a collection of real businesses, real employees, customers, products, profits. When the US goes to war, those businesses don't stop operating. Often they accelerate. Defense produces more. Energy sees prices rise. The economy adapts. The American economy is the most resilient system ever built. It survived world wars, depression, countless recessions, terrorist attacks, financial crisis, pandemics. Through all of it, the trend has been up. Now let's get specific about this conflict. Iran produces about 3.3 million barrels of oil per day. Any escalation increases supply risk, even if no facilities are hit. Traders price in the possibility. So, oil prices go up, not because supply is cut, because traders price in the risk. Oil is input to everything: transportation, manufacturing, shipping, agriculture. When oil rises, inflation follows. Higher oil means higher inflation. Higher inflation means the Fed might keep rates higher. They want to cut rates. If inflation stays sticky, they can't. Higher rates affect everything: mortgages, car loans, corporate investment. Those AI data centers borrowing hundreds of billions. If it costs a point more, that's real money. Lower investment means lower profits. That flows through to stock prices. This is why markets drop initially, not because war destroys value, because ripple effects create uncertainty. Here's the framework professionals use. 3 phases during any conflict. Phase 1. Shock. Immediate reaction. Fast. Violent. Driven by emotion and algorithms. Oil spikes. Gold spikes. VIX jumps. Risk stocks drop. Lasts days or weeks. Key insight: don't try to time this. Buy oil, gold, defense at these moments, you're buying high. Research shows you'll likely sell low. Phase 2. Repricing. Panic subsides. Money asks what happens next, temporary or structural. Will inflation stay high? What will the Fed do? This is where institutions reposition, not in chaos, in clarity. This is where they make money. Phase 3. Rotation. Money flows from some sectors to others. This is where opportunity appears. Rather than buying oil or gold after they've spiked, smart money buys the shovels. Energy service companies, pipeline companies, storage terminals. They benefit from higher oil prices with less volatility. They collect tolls on oil moving around. Defense contractors, yes, they run up. Some names up 30+%. But defense spending is about multi-year contracts. Governments sign 10-year deals. Major contractors have backlogs in hundreds of billions. Short-term spike is interesting, but there's a structural case too. Just don't put everything in one defense stock. Spread it around. Gold? Bank of America. Data shows 6 months after a shock, gold outperforms by about 19% on average. Oil spikes, then comes down. Gold tends to stay elevated. Oil is short-term play. Gold is longer-term positioning. What makes gold go up? Higher inflation. Fear. Central banks buying. Pretty simple. Important context. Before this conflict, the market was already massively overvalued. S&P trading at elevated multiples. Margin of safety for new buyers is thin. Buffett indicator, market cap versus GDP, shows over 120% overvalued. Historically, at 50% overvalued, next 10-year returns average negative. At 125%, that matters. If the market sells off 5 or 10%, does that bring stocks to fair value? Yes, cheaper. Does it make them cheap? No. Drop from overvalued to fairly valued is opportunity. Drop from overvalued to slightly less overvalued? Not buying opportunity of a lifetime. House worth $500,000 listed at $5 million, nobody buys. Drop to $3 million, 40% discount. Screaming deal? No. Still $3 million on $500,000 value. Cheaper doesn't mean cheap. When fear appears, retail investors make one of 3 moves. Sell everything to cash, feel safe. But cash loses to inflation, freeze completely. Stare at market, hope things improve. Chase whatever's going up, oil, defense, gold. Problem? By the time average investor notices those sectors, they've already surged. Buy at top, sell after excitement fades. I've watched this again and again. Institutions behave differently. They're not reacting emotionally. They're analyzing money flows. Instead of, will this war happen? They ask, how will capital move if it does? Market isn't one giant pile. It's dozens of sectors, over 100 industries. When conditions change, money rotates between them. Understanding rotation is where real opportunity lives. Here's my framework for right now. If you're in broad market ETFs like S&P 500, keep dollar cost averaging. Don't stop. Don't time the market. Don't wait for things to settle. By then, recovery's already happened. Consistent, disciplined contributions into diversified ETFs over long time horizons is one of the most reliable wealth-building strategies. Don't let headlines interrupt that. If you're in individual stocks, this environment demands discipline. Only buy when a stock trades well below your estimate of its value. Intrinsic value, that's margin of safety. With markets so overvalued, list of companies with massive margin of safety is shorter than normal. Pockets of opportunity exist. But don't use Iran headline as reason to buy. Question is never, should I buy because market is down? Question is this business trading below what I think it's worth based on long-term value? Pendulum will swing. Markets go from overvalued to undervalued and back. We're on overvalued side now. At some point, driven by something, it will swing back. When it does, investors who are prepared, who've done homework, know what prices they want, will have extraordinary opportunity. Investors who panicked or chased headlines won't be in position to take advantage. Emotional investor hears Iran tensions and immediately moves money. Sells stocks that feel risky. Buys oil because it's going up. Buys defense because it's going up. Feels proactive. One step ahead. They're not. They're the crowd. By the time they've moved, professionals have already priced it in. Emotional investor is always last to buy, last to sell. Logical investor hears Iran tensions and asks, does this change intrinsic value of businesses I own? 20 years from now, is this business affected by this conflict? Not stock price, actual value. Does this change how many iPhones Apple sells over 2 decades? Probably not. Does it change whether Visa processes transactions? Probably not. Does it change whether best businesses continue compounding earnings? In most cases, answer is no. Logical investor sits on hands and does nothing, or does more homework. Looks whether sell-off created opportunities. Any stocks dropped below fair value? If that happens, they buy. Not because of Iran, because of value. Price versus value. Stop watching the news. I'm serious. You don't need 24-hour horror loop. It messes with your head. Stops calm, informed decisions. You'll know what's going on. Someone will tell you. Headline appears. That's all you need. Rest is designed to keep you scared and clicking. All news I need is in the market. I see where money moves. That's all that matters. Smart investing isn't dramatic. No chest beating. No trade of the decade. Structure, patterns, rules. People doing this for decades aren't making big aggressive bets on headlines. This isn't a TV show. This is your retirement. Financial safety for you and your family. Measured, controlled moves where you know downside. Get risk management right, you'll make money. Least sexy thing I could say, but it's truth. 5 principles. Write these down. 1. I am an investor, not a speculator. 2. Every investment is present value of all future cash flow it will generate. 3. If I don't understand it, I don't buy it. 4. Short run, stocks are voting machine. Long run, weighing machine. 5. Great story becomes bad investment if you pay wrong price. History is clear. Wars are scary. Markets drop, markets recover, Investors who held through World War II, Vietnam, Gulf War, 9/11, Iraq, Afghanistan, Russia, Ukraine, they came out massively ahead. No reason to believe this time is different. There never is. I'm money. I've moved through world wars, financial crises, recessions, booms. One thing I've learned: fear is loud. Patience is powerful. Conflicts come and go. Markets fall and recover. Investors who stay disciplined through uncertainty build real wealth over time. Keep dollar cost averaging into ETFs. Only buy individual stocks selling well below intrinsic value. Stay patient. Be prepared for when market sells off to genuinely cheap levels. When that happens, driven by this conflict or something else, prepared investors will have extraordinary opportunity. I made this video because right now, while this story unfolds, thousands make emotional decisions they'll regret. People like Daniel, staring at phones, feeling urged to sell everything. If I can get you to pause, breathe, think logically before acting, this video did its job. Investors who build generational wealth, not the ones who react fastest, not the ones who panic first, the ones who don't react at all. Be that investor. Next time news screams about geopolitical tension, remember what you learned. Remember the pattern. 3 phases. Cheaper isn't always cheap. Understanding how money moves is far more powerful than reacting to headlines. Thank you for your time. Stay calm. Stay disciplined. Stop watching the news.